Our next speaker is Paul Ross, who's owner and chief scientist for Paul & Ross, a company that uses research, data analytics, and advisory services in Australia and overseas to evaluate finance, economics, and residential property markets. He's had various positions in financial institutions and in early 2011 established a research institute for an Australian financial institution where he's responsible for designing and implementing its strategic and operational platform. So he's going to be talking about the risk business. So please welcome Paul Ross. Paul.
Thank you. I just want to say, first of all, thank you very much to Esri and to everyone coming along to hear me speak today. My style of presentation will be a combination of reading my notes, hope you don't mind, but also kind of illustrating just like interactively with the maps, which will kind of unfold through the course of the presentation. Just by way of some background, I just thought I'd talk about my own risky geodesign journey here to Redlands. I have the most terrible fear of flying, so I was having this predicament of how am I going to get to Redlands? You know, it's like 6 weeks by boat, and it's bad enough taking a 15-hour flight. So I went through these various stages. Yes, I'm going. No, I'm not. Yes, I'm going. Well, perhaps if I fly, it'd be a bit easier, or if I take a boat, it'd be even easier. And then I thought, oh, somebody else can go. And consequently, I just accepted the situation and submerged myself into this opportunity to come to Redlands. Obviously, Redlands is a place I've been hearing about since I was 19 years old, which is 20 years ago, yeah. And so to kind of come down New York Street and actually see this grand office was it was quite exciting actually to get here. And I survived the plane ride. Hopefully I'll survive the plane ride back. Risk is everywhere. It is central to our thoughts, our behaviors, our language, our decisions, our transactions, and our plans. We try and make linear from non-linear and calm from chaos. And obviously we have various or varying successes and failures with that. In an attempt to unravel and explain the chaotic effects of our collective actions, this presentation will introduce how the integration of geodesign decision-making can help financial risk managers better understand the knowns, the unknowns, and the super unknowns of financial risk management. I got this slide sent to me a week or two ago by a former colleague, and this really sort of having worked in banking for 10, 11 years, this really kind of resonated with me, and I know I'm on camera, so I'll be mindful of what I say, but it really reminded me of my boss, and it's like, I had this particular experience, and yeah, it was up there with Santa Claus not being real. It was quite alarming. But to get to the point, in banking and financial circles, we endeavor to manipulate the effect of risk and cover its fallout, as the GFC kind of clearly demonstrated. But irrespective of sector, the challenge remains understanding and measuring the impact of risk. In my opinion, from what I can see, risk management frameworks have proven to be largely ineffective in measuring the potential effects of natural hazards on our physical and built environments. Unfortunately, it takes a disaster on an enormous scale, like the ones we see in this page. And there's obviously New York, which was decimated back in 2012, the horrendous situation in New Orleans in 2005, what happened in Fukushima in 2011, I think it was in March. And then in January 2011, we had the situation in Brisbane, Australia, where the Brisbane River literally burst its banks. So here's an example. This is the convention center in Brisbane. So imagine the San Diego Convention Center kind of covered like that. It would be quite a shocking prospect. And I actually found this image on the Brisbane newspaper, and I don't know how many of you have been to Australia or how familiar you are with Australian personalities, but the guy on my left he's your typical Queenslander, and just watching the water go by, it's I don't think you'd see that in too many other cities, but there we go. But unfortunately, when a disaster happens, only when a disaster happens are the responsible parties mobilized. Public inquiries are launched and they find gaps in policy, regulation, and governance when the detail of cause and effect in disaster impact assessment is questioned. Business risk. Those three lovely words, profit, loss, and risk. You know, that kind of, I'm not too sure about this audience, but those are the kind of words that I've been living with quite closely for a bit too long. But in this instance, business risk assesses how households, communities, or businesses measure up against financial models and their current and potential relative risk to an event. These are based on amplifiers and minimizers. An example, amplifiers, whether you live in a flood risk area, whether you're on low income, or whether you have existing debts. Minimizers, do you have flood insurance? How old are you? How much money you got? And the combination of customer metrics and other externalities help gauge the costs associated with various risk appetites. The key geodesign type questions in the mind of the financial risk manager include: what and who is the population at risk? Do we have customers living there? What are the impacts and probabilities of a natural disaster impacting this area in the future? And how can these be minimized? Risk is a central part of doing business, and sometimes the stakes are exceptionally high. Take Lehman Brothers, for example. The forced merger between Bank of America and Merrill Lynch. The ever-enduring Goldman Sachs, and the risk absorber of Citadel Investment Group. The characters of risk are equally as infamous. Here is the original loan shark, Shylock, in Shakespeare's Merchant of Venice, if you're familiar with the play. And a more contemporary character, Mr. Gecko from Wall Street. But the appetites are equally as sensational as the characters. Here we have the original Mr. Bond, Nathan Rothschild, the man who financed and made an absolute fortune from the Napoleonic Wars. And a more colloquial form of war, immortalized in Goodfellas. Certainly a very crass way of making money, but certainly a very lucrative way. First prize, however, goes to Barings Bank and the gambling Nick Leeson. Nick wagered that the yen would not drop. He went to bed that night, and it did. Why did it drop? There was an earthquake in Japan. The effects on Kobe were horrendous, terrible, but the city was rebuilt. In financial talks, Barings took a bath and was never seen again. This foray into financial risk management through events or popular culture reminds us of the dangers and unknowns associated with risk, but if executed well, risks can be minimized. On that note, risk is all about perspective, especially in banking, and sentiment. In banking, risk is usually economic, with little thought of social or environmental principles. Property development is pretty much the same, but has a broader appreciation of terms that I've heard here today about landscape, aesthetics, and designs. But as cities get bigger, the demand for housing increases, giving rise to large land use constraints, which makes housing finance increasingly risky and increasingly expensive. However, a new discourse, integrating geodesign and business risk management. And prior to coming here, I hadn't really done that much in-depth reading on the concept of geodesign, but what reading I had done, I kind of came up with this definition, which I thought would be quite helpful for my type of thinking and the thinking of the people who I tend to deal with. So a sequence of practical steps helping improve the quality of urban environments and supporting decision makers in their efforts to minimize risk. There's a proposed dialogue to this, offering visibility and understanding into the layers of a landscape, where investments sit geographically, and the composite level of risk associated with an area. Looking at land use, policy, regulation, and governance, and how they are administered and managed, the key components have been partitioned into what I've called hardware and software. Hardware, this includes landscaping our physical environments to suit our needs, which we coordinate via planning and control via engineering structures to support our built environments. On the other side of the coin, we've got the software, These built environments accommodate our social structures and uphold our cultural identity. They also support our economic transactions and ensure the flow of money. These components of hardware and software are held together by policies and regulations of various standards. Some have rigorous risk management systems and processes, and as you all know, some don't, which are reflected in how they are administered, coordinated, and controlled. The risks in our world, natural disasters. Australia is a country which is just, it just seems to be every year we're inundated with something or other. It's, floods, fires, take your pick, and here we are on the Australian highway of life, and this is what you see. There's always something. But today I'm going to do a brief introduction into around the types of geoanalysis that we've been applying and some small-scale geodesign scenarios in relation to the Brisbane flood. As a data person as opposed to a GIS expert, we've done quite a bit of modeling around the analysis of population, housing, and financial indicators. We've also looked at the impact of the flood on the city's housing market and its respective finances, and we've endeavored to provide some rather basic geodesign type responses. First of all, for those of you not familiar with where Australia is, it's down there. And here is down there, it's, or down under should I say. This area to the top is where Queensland is, and inset from that is where Brisbane is. Respectively, the map below that gives you a kind of regional breakdown of southeast Queensland, which is quite a big area. Needless to say, it's quite populated as well. Brisbane's kind of come a long way in the last 40 years. It's now a metropolis of 2 million people, which is quite substantial. It's quite a large area, 6,000 square kilometers. I'm sorry, I don't know the miles, what that is, but I'll leave that. I think it's about 4,000 or so. And as you can see, population growth, this is annualized growth in the 40 years to 2011, quite strong, 2.25%. That's only really slowed in the last little while, and the outlook forecast by the Australian government is just under 2% over the next 17 years. Just some topographical kind of context. Here we have a map of southeast Queensland with the waterways, the parkland, and the residential areas. So as you can see, there's a rather big dam there, and there's a rather big river there. We'll get to those in a minute. The chart we have here is in relation to the Southern Oscillation Index, or the SOI, which is it's like a barometer really of how La Nina is behaving. And as you can see, in 2011, she was getting pretty angry, and those numbers were really starting to escalate, which explains the next slide. It started raining and raining. And I remember this month of January, we had a cyclone up in Cairns, which is in the north part of Queensland, and the place was just wiped out. Consequently, it just kept raining and moving further south. And by mid-January, it was just raining every day, even in Sydney, where I live, which is about another 1,000 kilometers further south. By way of example, we've included the rainfall for January 2011 and comparing that to January 1974. 1974 was literally when Brisbane was washed away. And the kind of comparisons between those two floods are quite similar, but the one in 74 was significantly worse. After the flood in 74, the Queensland and the federal government of Australia decided to build a dam, which I kind of pointed out to you just earlier. And as you can see, that's on the 8th of January, and that's on the 18th of January. So in that period of time, the elevation of the water behind the dam had got pretty high. And the flow of water was it was getting pretty high as well. So there was one thing to do, open the dam. But the thing they didn't take into account, which is absolutely incredible, is that they forgot to include in their modeling that it was still raining. So when the water was going downstream, the rainwater was coming out of the sky going into the river, so the flow was getting higher, so it just magnified the effects which they hadn't anticipated. And here is the effect. 95 postcodes in Brisbane were saturated. That's about approximately 70% of the metropolitan area of Brisbane. So, if you will, here's the dam, comes down here, and then it trickled all the way through here. And literally, people could see it coming. It was that obvious. Getting into our case study, We focused on the central business district, or the downtown area of Brisbane, which kind of, as you can see, it kind of straddles the river from here in the south up to here in the north. That's not a particularly big distance, probably about 5 or 6 kilometers. But within that area, there's quite a high density of commercial real estate and residential real estate, which is as presented on the thematic on the right-hand side. As you can see, approximately 30% of land use parcels in this area are residential, and about 20% are commercial. These parcels were selected because these are the ones which were flooded. We retrieved aerial photographs from a company in Australia who essentially we digitized them into ArcGIS, and that's how we come up with these zones here. We then applied a different scenario and thought, okay, how about we apply a buffer? And essentially we discovered that the population in those in that buffer, it tripled. And what was 40,000 within that those flooded areas had incremented to 120,000. And as you can see in the thematic on the right, red represents residential. So obviously a lot of housing in that area. So if the flood had been that much worse, the potential population at risk and housing at risk would have been significantly higher, not to mention the number of mortgage dwellings at risk as well. To commence the at-risk analysis, figures 5, 6, and 7, they present growth in population across the case study area, the buffer zone, and as I mentioned, the 95 postcode areas. These three geographies are presented across each of these three variables. And as you can see, we've presented it by time. So for the purpose of this presentation, we've simplified it into 5-year kind of bands, 6 to 11, and then 11 to 16. So obviously there's a forecast there. We forecast our models on a quarterly basis moving forward. And the reason we picked 11 was simply the flood was in 11. So it was essentially a kind of before and after, just to kind of distinguish between what was going on pre-flood, what has been going on post-flood, and what do we anticipate will continue going on post-flood. As you can see, population growth has been relatively unchanged, and take note of these numbers, they're quite small. These are percentages. That's just about, in the case study area, it's about 1.5%. But bear in mind, here's stock growth. That's less than 0.5%, and as you can see in the historical period, it was relatively insignificant, really. There was very little growth. However, growth did pick up in the forecast period, and that's obviously eased density levels, which, as you can see here, the increase in stock in the forecast period, I mean, that relieves affordability constraints, but it does create a higher population at risk if a flood does come downstream again. In this particular chart, again, the three geographies, the respective points in time, but this time we're demonstrating it across more financial type indicators, mortgage growth, average price growth, and average mortgage repayment. As you can see there, in the historical period, it was actually negative. People were actually leaving the kind of case study area, and respectively it was taking place here. Strange. But as you can see in the forecast period, the figures have picked up, so people are kind of shaking off the effects of the GFC and the flood. Sluggish price growth might be responsible for this trend, and in tandem with low interest rates. Interest rates have been up and down in Australia. I know they've been quite flat here for quite some time, but our current interest rate's about 5 or 6%. So it went as low as 3, but it's gone back up. So as a result of currently lower interest rates, repayments are relatively low, and consequently that kind of encourages people to kind of invest or purchase. Cities are complex systems with endless interactions, and the population and housing related trends were not really hampered by the flood at all, despite a whole raft of new flood and planning regulations and costs. People aspire to live in these areas. Why? Because they're rich in amenity and they're close to work. What could geodesign do to ease hardware software incompatibility or compatibility? By looking at the causes, it would be possible to test many scenarios by altering the underlying hardware and software using the at-risk data to better understand land use challenges and financial burdens. Then by looking at the effects, it would be possible to measure and evaluate the merit and impact of these scenarios on, for example, policy formulation and sentiment, how to better design communities in flood risk areas, and how to minimize financial risk and exposure. A little chronicle on Brisbane and the effects of the GFC on the overall sort of housing market. As I mentioned earlier, it's a city of 2.2 million people. 40 years ago, Brisbane was a country town, and it really does still have that sort of essence about it, really. But it has become a metropolis, and home ownership in this particular city just skyrocketed. There was an exodus of retirees from Melbourne, which is in the south of Australia, in the 80s, and they just flocked to Brisbane, leaving the kind of rains of Melbourne, for the kind of sunshine of Brisbane and the Gold Coast. Consequently, in response, property developers just rubbed their hands with glee, and it was spectacular, the amount of growth. And suffice to say, a lot of corners were sliced and diced in some rather unorthodox ways from what I've heard. This was all fine and dandy till about 2006. It was a rising market. Then, as you know only too well, here in the United States, the GFC arrived. Interesting response from the Reserve Bank was to kind of it encouraged kind of people to buy through some quite generous kind of fiscal and monetary sort of policies. And that created, in my opinion, a more kind of volatile market. It created more debt. It encouraged a lot of, shall I say, younger borrowers or first homeowners into the market who were generally borrowing 90% with only putting down 10% in equity. That created more exposure, which creates more risk. So in essence, it's a rather leveraged residential market. Fast forward to 2011, or January 2011, then a flood hits. You've got all these people who are highly leveraged living in this particular area. Consequently, that's creating even more risk. The impact is credit quality deterioration. That's when the banks kind of wake up and go, we've got a problem here. And the next 6 slides are just a series of thematics, kind of teasing out some of the kind of the core issues which we kind of look at when looking at risk at a localized level. In this case, we're looking at the postcodes which are within the respective buffer zone. I've just kind of put a little kind of wrapper. I don't know if you can see that particularly well, but what all that is the kind of the extent of the 500-meter buffer, and these are the respective postcodes. In this particular map, we're looking at affordability, and as you can see, it's a rather simplistic scale, light green through to red. Where it's red, that means that, I'll just say where it's green, that means that affordability is very, very, very good. Where it's red, you're getting a bit stressed, and that's what the map 12 is aiming to demonstrate. The ones kind of enveloped with a turquoise sort of color, these are areas where affordability is, or the amount that you're paying from your disposable income is over 30% to live in these areas. And as you can see, 4102 seems to be the most expensive one. Here we have average number of mortgaged houses, and again, the same sort of principle in the thematic, light green through to red, and you can see the distribution there. We've added an additional indicator here, these sort of black plumes, and that represents average mortgage size. They're only represented if the value is greater than 1 standard deviation above the mean. And here we have the kind of the real big one down here. Interestingly enough, in this particular area, this was absolutely decimated by the flood in 2011. So from a bank's point of view, that was a bit of a worry when you see that people's average loan size is kind of quite high in that area. An obvious one is looking at mortgage repayments greater than $3,000 a month. As you can see, this is the central business district of the downtown of Brisbane. As you'd expect in any city around the world, these areas closest to the CBD are always going to be the most expensive. So consequently, you are going to get a higher kind of density of mortgage repayments over $3,000 a month, for example. Average level of mortgage debt. This is what is called loan-to-value ratio. As you can see, I mentioned the kind of the area down here, 4106. Interestingly enough, they are the most highly leveraged people in the at-risk area. So again, that's a confirmation rather that it is a kind of risky sort of area. And then this is the one which makes investment banks and rating agencies flip out, basically. It's when they kind of see that the situation of negative liquidity. Essentially, that means there's more debt. So these mortgages would have been written at, say, between December 10 and September 13. At the point in time of origination back in December 10, they were in better shape. By September 13, they're in worse shape. Why are they in worse shape? Because the underlying asset value has deteriorated. Consequently, we've done a kind of a forecast analysis using a 6-year maturity, and what we have identified is that the kind of exposure of debt is actually getting worse. So on the basis of this study, you can see that the concentration of kind of red blobs is getting more apparent. So you know, it's if you are a financier and you do have exposure in that area, it is kind of worthwhile to be mindful of some of these thematics. The good, and the not so good. You know, I watched the news on what happened with Hurricane Katrina, and it was pretty alarming. And in preparation for this, I've done quite a bit of reading on what actually went on there, and it was quite surprising. And it was in somewhat contrast to what the response was to the flood in Brisbane. The public response was just incredible. I mean, people, volunteers from all over the country just honed in on going to Brisbane and just kind of essentially bringing the city back to life, and that's what they did. So did the taxpayer. I mean, anyone earning more than $50,000 a year was slapped up with a 3% levy. So that generated about $2 billion in tax revenue. So obviously that was a good way to kind of help get the city back on track. There was also a kind of a significant overhaul of water and disaster management, and there was the launching of the Disaster Reconstruction Authority. Esri Australia actually designed I think it would be called an IMS site for, I think they still call it that, for the authority. And essentially, every time you make an application for finance or insurance, you've got to go into this particular application, or your broker will go into it, or your bank will go into it, or your insurer will go into it, and they'll assess: are you living in a flood zone? Is it an area? Is it a land parcel which is susceptible to flooding at 1, 2, or 2+ meters? And consequently, your respective amount of flood risk is assessed on the basis of that, and that can be a make or break. That can determine whether you get a mortgage or whether you don't get a mortgage. There's also been a bit of a push towards riverine insurance. Again, my reading about Katrina, a lot of these homes, they weren't covered by riverine insurance, and I was quite shocked by that. But then, as I discovered, in Australia, it's no different. There are no policies or products in the financial world which really kind of cater for riverine insurance. So, I mean, by and large, effectively, if you live in a riverine flooded area, your policy is essentially worthless. The final point about geodesign is that they have been very active in trying to kind of get the state government to kind of become a bit more accountable. The dam that I mentioned that was kind of, someone opened the tap, it wasn't insured. Subsequently, all the levees downstream weren't insured either, so their infrastructural assets weren't insured. A lot of them were in poor quality, quite bad kind of condition. So, you know, I understand that there's been some GIS studies looking at, okay, these are your kind of particular infrastructural points. This is where you need to do it up. And it's obviously been quite active in terms of helping get local councils involved, and all local councils have had to embrace some sort of GIS technology and integrate that into their environmental impact assessment planning. Despite these flaws, you know, the Queensland government it's done pretty well. And it's more than could be said for its private sector compadres. I think this really sums it up. After the flood rains comes the flood claims, but you know, that's pretty alarming. 10%, and you know, that's what, 3 years ago. I'm not too sure about the situation with the payouts from Katrina, but I think that's run its course, and I think a lot of people were shortchanged as well, shall we say. Primarily because, as I mentioned earlier, there is no riverine type insurance policy. The banks, however, and insurers are not so easily convinced by the ability of the state government to be accountable. As a result, they have investigated ways to insure their assets beyond conventional protocols. Protecting bonds associated with an asset financed by debt is critical to the risk manager, and there's a growing reliance on hedge funds. In New York, the Transit Authority took out a hedge following the flooding of the subway stations by Hurricane Sandy with a maturity of 3 years. What does that mean? Well, the hurricane was in October 2012, so they've taken out a 3-year hedge. So if there's a flood between October 2012 and October 2015, happy days for New York City Transit. They'll get their money back. If not, they'll basically lose the lot. But it's a catch-22, isn't it? You know, once you start kind of paying a hedge fund, and then it runs out, it's kind of like you're playing cat and mouse. It's like, okay, I've got to keep this going in case it does come. It might come the day after my policy expires. It's a rather expensive business. The big insurer, QBE, they've got involved in this kind of reinsurance catastrophe bond market as well. They recently settled a transaction in Australia for $250 million, following just a spate of losses from natural disasters. To that end, it's a no-brainer in my opinion. Queensland is this decimated almost every year by flooding and fires. I mean, just last week on Thursday, just before I was coming over here, there was flash flooding in Brisbane yet again. Where are we? We're on the 29th of January. You know, it's like clockwork. As a result, the public had to pay for the kind of the recovery of Brisbane, and as a result, Brisbane lost its AAA bond rating. It's now double A, so quite an expensive business for them. A couple of ideas to finish with. The geodesign code, it is certainly, from what I can gather from being here today, it's certainly kind of well established in the land use planning sort of areas. It's just a case of nurturing hardware and software compatibility is a bit better. The big challenge I see for geodesign in the industry I work in is overcoming cultural biases to non-conventional analyses like GIS and geodesign and geography. Bankers think they know it all, and I'll repeat that, bankers think they know it all. So it's quite, it is a hurdle, and I've experienced that for a decade now. It's challenging to make them appreciate the value of geography. However, flooding, Queensland has really embraced this in the aftermath of the flood, and as I mentioned, it is actively used in planning and now in kind of credit evaluation for insurance policies. Just a quirky little finish. The future of geodesign strategy, which kind of floats around in my mind. It is a kind of a core concept in urban design and planning, and it has the capacity to be a core concept in financial management as well. It can help coordinate and manage and control flooded cities in the 21st century. I have this concept in my head of floating cities. Essentially kind of create a flood portal, you know, and just a bit. Essentially, we've got so many flooded cities in the world, it's surely to goodness they can get together and start collecting data and have a portal which would be a very useful sort of kind of information tool. If we don't do that, we've got this predicament here, and we all know where this ended up. So that's just a kind of a small kind of side comment on which to finish. Thank you very much.